Well, now it's time to see what's making news in the world of business. For that, we're joined by Jameel Ahmad, Chief Analyst at GTC. Jameel, markets are still reacting to the Fed pushing back further US interest rate cuts and last week's sell-off.
It's certainly been a busy start to 2025, and I think there's a couple of different perspectives that you can take on this. Firstly, financial markets had a fantastic 2024. So potentially there is room there to say that at some point we're going to have some sort of correction. But what seems to have really started to put those wheels in order for the markets to fall, all three of the US major stock markets declined for the first full trading week of 2025. It started with the Fed. The US Central Bank in their minutes showed some concerns about the incoming presidency and that some of those tactics from trade tariffs to fiscal stimulus and so forth could push inflation projections back up north, higher. And because of this, we should prepare ourselves that potentially after the 3 interest rate cuts that the Fed delivered last year, that in 2025 we won't see as many interest rate cuts. At that point, financial markets started to expect that we might only see 2 US interest rate cuts in 2025. And then we had a fantastic US monthly jobs report at the end of last week, which has suggested that potentially the US economy is going to do so well that maybe we're not going to have any US interest rate cuts at all in 2025. I think that's a bit premature to say right now, but because of this, financial markets have started the next trading week on the red foot, on the back foot as well.
Well, tell us more then about that latest US jobs report, further casting doubt on future interest rate cuts.
So the US economy in December added more than 250,000 jobs, which was more than 100,000 on the expected. We were expecting a lower number because of the unfortunate natural disasters and other events that have been taking place in the United States over the final quarter of 2024. But we completely bucked those expectations. And we're seeing once again that other economies like the European Union, the United Kingdom, and some of the advanced nations are not showing so much economic momentum. But the United States is on a completely different planet. And it's been that way now for not only 2024, but also through the final quarter and so forth of 2023. So we're seeing that discrepancy in economic sentiment continue to extend. And based on that US jobs report, we've seen that the interest rate expectations have declined substantially. Some are saying there's not going to be any cuts at all in 2025, but we're already seeing more than a 95% chance that we're going to have no interest rate cut at all in March, which is a significant decline to what we had just before that reading. So we do expect some sensitivity up until more economic data, and also in terms of that inauguration that's going to take place 1 week from now.
All right, Jameel, and what other key data are you watching out for this week?
The interest rate topic is not going to go away. That's because we have inflation reports from the likes of the United Kingdom, the European Union, and of course, the United States this week. Interesting thing is that when it comes to the United Kingdom and the European Union, we are expecting more interest rate cuts in 2025. So potentially going to have some movement in UK and EU markets. We shouldn't forget as well that later this week, we have a US retail sales report. Consumer spending does account for the largest component of the US economic GDP. So more spending there and more growth should even further dash back and the US interest rate talk. At the end of the week, though, we do have China GDP. And we're expecting to have a lot of talk about China over this coming week. And I think we're going to be focusing on this more as we head into tomorrow and further.
All right, a data-heavy week then. Thank you very much, Jameel Ahmad, Chief Analyst at GTC, for that business update. Thank you to you for watching. We're going to take a short break. We'll be back after this.